Welcome, everybody. Welcome to Colliers 19th Annual Outlook Conference. We've really got a great crowd here, a big group. We appreciate everybody's patience getting seated so we can get started. Today we've got, we're in interesting times with the economy, a lot of questions, and I think we've put together a great layout to probably raise more questions and also answer a lot of them. Couple of speakers that are really experts in the economy and the labor market. And then we've got our panel of local experts that are going to talk more about, specifically what's happening here and the trends they're seeing. First thing I want to do is just a few thanks. And we've done this, again, this is our 19th year. We can't do it without the help of all of our sponsors. We've got such a great group of loyal sponsors. First of all, our presenting sponsors, A10 Capital, Washington Trust Bank, Givens Pursley, and Land Pro Data. All of our presenting sponsors, along with all of our sponsors, have representatives here, and hopefully you had a chance to mingle and talk to them a bit out front. But also afterwards, we have a cocktail reception. There'll be an opportunity. Please say hello to them, get business cards, make some connections. It's really a great group. And again, we can't pull this off each year, despite our amazing marketing team and their efforts. We can't pull this off without all the sponsors. Also, Centimark Roofing, Syringa Networks, Neuralink, and I'm losing my cue card here to remember all of the names of the sponsors that are out there. Our supporting sponsors that are responsible for putting this together with us. And I'm sorry, Centimark, Neuralink, Syringa, Alliance Title, Infinity Signs, Cutting Edge Landscape, and ServPro. These are all companies that we do extensive work with, and particularly in our property management arena. And I look at Washington Trust Bank. We do all of our banking with Washington Trust. Givens Pursley helps keep us out of trouble. These are all people that we really rely on and attest to their skills and abilities. So please get to know them, and thank you to our sponsors. Very, very quickly, just a little bit about Colliers. Most of you know us. That's why you're here. Colliers is the largest commercial real estate company in the state, with folks in Boise, Nampa, Twin Falls, Pocatello, and Idaho Falls. We also have the largest property management, third-party property management portfolio in the state. We're very proud of the fact that the last 2 years running, we've been named the #1 commercial real estate company for brokerage and the #1 property management company through the IBR reader rankings, which is all of you saying who's the best, and we're very proud to have that distinction, and we work hard to continue that. So before I introduce Tom LaSalvia, our first speaker, I just want to throw out a few ideas, a few things for people to think about, and as you're listening to the data and some of the different information. With all respect to some of our economic development folks, I don't know if Clark Krause is here, but with BVEP, Clark, I am going to use the big R word today. We do that, the recession. Are we in it? Are we not in it? Are we heading into one? A lot of unknowns, and it depends who you listen to. We also, inflation, interest rates, and the E word that's coming up, elections. So a lot of uncertainty. I think if you look back, and I've lived through now, I think this is 7 or 8 recessions. They happen, they come, they go. The question is how deep, how long, which segments of industry and the economy are most impacted. And the age-old, sign of a recession has always been 2 consecutive quarters of negative GDP growth. Well, we've had that. And so a lot of people would say, well, we're in a recession. And I got to say, if I look outside right now, look out the window and see what's going on in Boise, if this is a recession, it doesn't feel too bad. We're very fortunate to be here, and we'll talk a lot about today some of the differences in our economy versus regional and national trends. But then, there's a very strong argument that we're not in a recession. If you look at definitions of recession, it also involves rising unemployment. That's not been happening. It involves contracting measures of profits, of income. And just this week, if anybody follows the stock market at all, you'll see that the earnings reporting season has come out, and the market was up 500 plus points on Monday, another couple hundred points yesterday. I haven't looked today, but certainly that's not contracting income and profits. That's a contradictory sign there. So as you look at this today, and as you listen, I think Tom will talk a lot about some of the economic indicators. And Hope will talk a lot about the labor workforce, and that's one of the big drivers in our market for how we move forward. Where do we find the labor? What labor support do we have? We've all heard about the labor shortages now for a couple of years since the pandemic. And the last thing I just want to, again, put the seed in the back of your mind. We talk a lot about normalizing. And a couple of years ago, I think we all got tired of hearing the term new norm with the pandemic. And that was referring to, hygiene protocols and working from home and things like that. We also got way out of the norm here in Idaho. It was a bit of an aberration, and I've seen articles where they talk about the Zoom town of Boise that's now crashing. We're not crashing. We got so far out ahead. Our growth was, you're looking at a home and saying it's appreciated 25% in a year or more. That's not the norm. We're normalizing. We're getting back in within the normal boundaries. And I think we've just got so many good signs, particularly here in Idaho in the Treasure Valley, of what's ahead. So with that, keep those things in mind as we're listening. I'm going to introduce our first speaker, Tom LaSalvia. Tom is with Moody's Analytics. If you're familiar with Moody's, they're really the leading financial information, financial intelligence company. They provide data to businesses, to consumers, to help make good decisions on companies they're working with. They're also driven, and we'll get into it a little bit later, but driven a lot by, the financial institutions, the lending sector. Ask them, they want information on companies. So they really do a deep dive. They know the economics. Tom is a senior economist, focusing and specialized in commercial real estate. Tom was, prior to his time at Moody's, he was a professor at the College of William and Mary in Virginia. Joined Moody's a few years ago. And I will say, after chasing him around the golf course yesterday, he's also actually got a pretty darn good swing, too, and a nice golf game. So with that, I'd like to welcome up Tom LaSalvia.
Thank you, Jim. Yes, thank you. So I have to tell you, Jim, his lovely wife over there, Shanalee, incredible hosts. I was treated like royalty yesterday. So Jim, thank you, Shanalee. Thank you so very, very much. And thank you to the Colliers organization for putting this on. Thank you for all the sponsors here. Thank you for everyone in the audience for sharing this beautiful state, this beautiful valley, beautiful city. I certainly understand now why it's gaining national attention. All right. It is an absolutely fascinating economic time, as Jim had set the stage for. So I'm not going to spend a lot of time doing that. What I want to do in my 20 minutes here is to ask and somewhat answer a variety of questions that I think many of you in this audience have. And while we may not have the precise answer, our crystal balls aren't that great, what I hope you get out of this is what to continue to look for as data is released, right? As time goes by, as the Fed makes decisions. And I think that will be a tremendous takeaway for you, a tremendous ability to help you with your daily business lives and your daily lives as you go forward. All right, so jumping right in. Start with the macroeconomy, and we'll start with that question that Jim posed. Are we in a recession? And I'm going to say to you right now with full confidence, no. Not at least yet, okay? So there's more to this. So here is the NBER, maybe it'll show up. Yeah, here is the NBER definition of a recession. A significant decline in economic activity that is spread across the economy and lasts for more than a few months. And sure, 2 quarters of negative real GDP growth, right? But that was on the back of 2 quarters of very, very positive GDP growth. So the word normalized was already used. I'm going to say Q4, when GDP grew by 6.9% on an annualized basis, that was far from normal. In the first 2 quarters of this year, we've corrected a little bit. Okay? I want to give you a few stats here. So if we looked at year-over-year real GDP, so meaning Q2 2021 through Q2 2022, actually grew at about 2%. Okay? Some of you might just say, well, that was just the rebound from the real trough from the early days of the pandemic. And there's some truth to that, of course. But if we look back at real GDP growth since 2019, that number sits at approximately 3.5%. All right, so that's 10 quarters, basically, since late 2019. If you go ahead and put that in an annual basis, we're about at 1.4%. So 1.4% annualized GDP over the last 10 quarters. So what does that mean? What's the reference point here? Well, macroeconomists that specialize in the US economy from the GDP perspective say that our potential GDP here is only about 2.1% per year. So yes, if we look through the last 10 quarters, a little bit slower growth, but not very far outside of the normal if you take away the noise of what's been going on in the pandemic and some of the issues associated with that. For the third quarter, early estimates, not only just from Moody's, but from the Fed, we're looking like a pretty strong third quarter from GDP numbers. So it's very likely that if you look at Q3 2021 through Q3 2022, we're going to be growing right at that 2% real GDP growth rate that is the potential of the US economy given the structure of our economy, the labor, and so on and so forth. So right now, we're pretty much at where we should be. All right. But we have inflation. We all know we have that. We all know we're struggling. So really quick, inflation is like toothpaste. If you haven't heard, this is a pretty good way to describe it. It's very easy to get out of the tube, especially when it's full. A little tough when there's not much. But very, very difficult and messy to get back in. And that's what we're dealing with right now when it comes to inflation. Inflation is caused by too much money chasing too few goods is always kind of the simplistic way that we describe inflation. It's a great way to do it because it brings in both the demand and the supply side of the equation. So too much money, demand. Employment, income, expectations. Now, I'm not going to talk too much about expectations on the next slides, but I think it's worth mentioning here. The way I want you thinking about expectations and how important it is, imagine if you were in the market to buy a new car, and you thought, you had the expectation that that vehicle that you want is going to increase in price 10% by next year. What are you more likely to do? Buy it right now before it starts going up in price. What do you do when you do that? You cause inflation. You cause further demand in the economy and you cause inflation. So expectations are very important. So you'll hear the Fed talking about bringing down expectations. You hear the Fed in their minutes or in their speeches saying, we are going to control this. And they're very strong about this. Why are they doing that? Why are they saying it so strongly? Because they want to control all of our expectations on inflation going forward. All right, then, Inflation is caused by too much money chasing too few goods. That's the supply side. We'll talk about supply chain issues, energy, and there's one thing that crosses over between demand and supply. It's kind of that employment side of things, because there's something called a wage price spiral, and we don't want to get in a wage price spiral. Essentially what happens there is all of us as workers see inflation. We don't like inflation. We say, I'm not working for you unless you give me more money. We get more money, we spend more money, and that causes more inflation. Then we ask for more money, we get more, it causes more inflation. And that's a wage price spiral. That's very much what we want to avoid. When is a bad thing a good thing? We're going to have to soften this labor market. We're going to have to reduce demand. We're going to have to reduce wage growth and spending growth. What do things look like right now? This is a 3-month rolling average of wage growth, okay? 3-month rolling average of wage growth. And you could see it's, if you take away the noise here, it's pretty flat. That's not a bad thing. It has to actually drop, though. We need that to drop. Here's something that is dropping. Advanced retail sales growth. 3-month rolling average here. And we're down actually slightly below 0 with the latest September numbers. So that's a combination of September and August and July. So when is a bad thing a good thing? This is when a bad thing is a good thing. When is a good thing a good thing? Lower oil prices, less supply chain issues typically lead to shifting out of the supply curve or increase in supply. Lower production, lower shipping costs. Here's the oil price, monthly average. We know it's a little bit of volatility over the last couple of weeks, but we're still sitting at kind of a low point with the oil price. And here's our own Moody's Analytics Supply Chain Stress Index, which includes things like port activity and labor shortages at major ports throughout the US. And you could see through this year, went up a bit. A lot of that had to do with China shutting down for COVID early in the year, and now it's trending downward. So a good thing is a good thing when we're seeing stuff like this. But isn't inflation still really high? So, right, you could say, Tom, hey, you just showed us pretty positive charts there. And I'm going to say inflation is high, but it depends on how you look at it. It depends on how it's reported. This is what the media likes to report. The year-over-year CPI number, okay? Stagnant, not budging from that slightly above 8%. That's way too high, right, from a year-over-year perspective, undoubtedly. Here's another perspective on inflation. 3-month rolling average takes into account recent inflation through the last couple of months. That's how to look at this. Look what's happened over the last half a year or so. Actually, with the September numbers, the 3-month rolling average is at the 2% Fed's comfort zone. So there has been progress made on the inflation front already, and that is good news. I'm not going to put on rose-colored glasses and say we're completely out of this. There's more work to be done, and I'm about to get there. But there is good news happening right now that's hidden in the news environment that we're in right now. All right, so what do the next 6 to 12 months look like, given what I've been talking about already? Fed's going to raise rates another 75 basis points in November. Almost guaranteed, so that's November 2nd is the end of those FOMC meetings. Watch for that. Then they'll have another set of meetings in December, the last meetings for the year, and likely 25 to 50 basis points there. Then I think the Fed's going to stop and play a waiting game. And there's a couple of scenarios that they're looking for. If supply side continues to improve, this is what's likely to happen. By early 23, maybe the February numbers, we'll see that year-over-year number that was stuck at 8% will be all the way down to 4%, much closer to where the Fed's comfort zone. From there, it's going to be tricky to get those last 2% overall, but we're on our way. And if that's the case, we avoid a deep recession or we avoid a recession altogether. If the supply side stumbles a bit, if there's more geopolitical issues, if we get into a bit of a wage price spiral, we're likely to see the CPI year over year around 6% instead. And if it's around 6% instead, that's not nearly enough for what the Fed ultimately needs to do to change the rhetoric on inflation, to change the momentum on inflation. The Fed's going to go hard at it again. And that is, at that point, may send us into a deep-ish recession. This is not 2008. All right, so if the optimistic outcome, if that occurs, is all well, I'm going to say not quite. The way our economy is right now, the situation that we're in, it's very likely that with the higher interest rate environments, we'll stick around for a while. With some of the other issues that we have, the volatility in the markets, slow GDP growth, so somewhere between 1% and 2% annualized, so slightly below that potential. Unemployment rate, right now we're at 3.5%, we're likely to go up a bit. If the pessimistic outcome is all hell, see my rhyming there? Not quite, right? As I said, this isn't 2008. So slow GDP growth, we're supposed to correct that. Didn't quite make it. So it's negative GDP growth of 1% to 2%, and an unemployment going up to closer to 6 to 7%. This is, again, not a 10% unemployment, great financial crisis situation. And what about Boise? Much better situation right now than this area, the Treasure Valley, Idaho, was in that recession 15 years ago or so. Different part of the growth path. Then a lot of it was speculation. Now, there's a tremendous amount of, in addition to the household in migration, the business in migration. And when that happens, you end up with businesses, and then you end up with people not moving here for the lifestyle or affordability, but you have more and more people moving here for the opportunities in the economy. And then that, if there's more people here, there's more skill here, and I'll leave that for Hope to talk about, that leads to more business activity. And you have a positive self-reinforcing cycle in that situation. So Boise's in a much different situation than 2008. Okay, so got about 6 minutes left. So I want to take you through a little bit of what this means from the CRE perspective. I already interjected a little bit, but of course, we're going to have higher interest rates. We're going to normalize with a 10-year treasury at 4.5%, something we haven't seen in a couple of decades, right? Still, we're not normalizing at 10, 12%. People in this room that probably had an 18, 19% mortgage on their house at some point, right, back in the early 80s. We're not having that, okay? But we know that we get increased financing costs. We know this could slow some development, probably not here as much, but marginal projects get axed in these types of situations. Financing freezes up a little bit. We're getting some signs of that already throughout the country. It dampens transactions. It separates buyers and sellers a little bit more in a situation where we have high interest rates but still have incredibly low cap rates. There's emerging evidence. Actually, I just read a Colliers bit of research on this using real capital analytics data and did a really nice job saying that across the country you are seeing transactions slow down. Decreased value appreciation, sure, we're not seeing that on average yet though. Difficulty refinancing, we're seeing a little bit of that from CMBS data already. Delinquencies are starting to go up, special servicing starting to go up. Weak labor market, of course, decreased wage and employment growth slows household formation, may hurt multifamily. Typically it goes Class A first, and then it will affect Class B, C, and then reduces space for all. All right, so that's the negative if we go into that deeper recessionary environment, which again, I really don't think we are headed that way, but there is still potential. CRE trends and forecast. All right, so back to some interesting questions here, I hope. Is it still location, location, location? Sort of. All right, this is interesting. More and more people that I talk to, it's still about location, but it's about the location of labor, skilled labor. Everything now is based off of that. The growing economies within the United States are all based off of where the skilled labor is. So this is really, really important. It's labor, labor, labor. I was even speaking with a developer of warehouse properties, and they said, yeah, obviously where the highways are, where the on and off ramps are, that's important, where the ports are, where our consumer base is, all very important. But if we don't have enough labor within 20-minute drive of our warehouse facility, we're not building there. So labor, labor, labor is incredibly important across the board, pretty much with all industries right now. What does this mean for Boise? Keep labor happy and keep it coming. Well, if you want that continued development and it's labor, 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 keep it happy, keep them coming. I am very much convinced that winners from the last decade and the pandemic era of migration, you have to satisfy these few criteria. Quality and cost-effective housing, quality in a variety of infrastructure, including really high-quality airport, but also things like light rail, if it makes sense. You want to keep those commute times down. And quality education and the diversity of skill and people. Is housing in Boise still affordable? Well, yes and no. So our data shows that rent growth has continued to outpace the nation. The blue bars there in that chart are Boise versus the nation in red. No declines in any of the years, even through the pandemic, but I don't have to tell you guys this. You guys are living through it. In our data, 276 markets, Boise ranks 81st highest asking rent, so that's still a good thing. Rent-to-income ratio around 22%, still a very good thing when you compare against a lot of peers. We do not see the multifamily housing market slowing very much at all. And I know we'll hear more about that in a little bit. But there is an ongoing correction in single family, that normalizing that Jim was talking about. All right, just have a minute and a half left. So how bad are things for the office? Not bad here from what I understand, that's for sure. At the national level, actually not that bad either, which is pretty fascinating given the remote work revolution here. If you look at the last couple of recessions compared to this economic time, this downturn, this is a really benign downturn for office, right? We didn't have bankruptcies. We didn't have office-using firms shedding workers. So they weren't shedding space either as they're in this bit of a holding period with remote work. Now, in a place like Boise, I know your physical occupancy is quite higher than the national average, but in places like New York and San Francisco, they're still really struggling with this, and office vacancies are rising a bit there, and they're having a bit more trouble. One of the interesting things that they're seeing, in particular those cities, flight to quality. So this is really fascinating. Occupied stock. This is an index, so basically if it's a positive slope, more occupied stock, a negative slope on these lines, less occupied stock. This is separated between Class A and BC properties. Class A, on the left-hand graph, this is for CBD, central business districts, dense urban areas typically. A is actually doing quite well. Occupied stock continues to rise. Look at how B has cratered in the last 4 quarters. All right, I'm going to finish up now. The last thing that I want to say here is regarding tech. And having an emerging tech market is vital. Look at the 2 blue lines on this chart. The light blue is established tech, the Silicon Valleys of the world. The dark blue is emerging tech, the Nashvilles, the Boises of the world. Doing so much better from an office perspective. So continue to push that forward. All right, and with that, I'm going to turn it back over, and I didn't get through all the sectors, but I'm happy to talk about it more in Q&A or afterwards with anybody of interest.
I just want to take a minute. There's a lot of information there to digest, a lot of great data. We have time for one or two questions right now for Tom, if anybody's got a question. We will have our next speaker, one or two questions, and our panel, and we'll have a larger Q&A at the end, so there'll be plenty of opportunities to ask questions. But if you do, I had one question given me. If you have a question and you want to ask Tom now, raise your hand and we'll get you a microphone. Here we go. Bill, thank you.
Tom, I'm Bill Johnson, the property owner in the fringe of the Treasure Valley. You explained inflation happens because there's too much money chasing too few goods. The Federal Reserve is trying to cut down the amount of money by increasing interest rates and unwinding their quantitative easing program. Congress, on the other hand, is glad to spend money, and we've seen unprecedented bills to do that, ARPA and CHIPS and infrastructure and such. Elections are coming up. How does the election change that congressional spending plan?
That's a fantastic question. So you're right. The administration, Congress, all together are very happy to continue to spend because it helps them get elected in their local areas. And in our forecasts right now, we're not expecting a tremendous amount of change when it comes to that dynamic. So the Fed is fighting a battle, essentially, against the government, the federal government, and even some state and local governments. And that's why in our forecasts, we need supply side help, right? It's not enough. The Fed would have to do just an unfortunate amount of increasing of rates over the next year or so if they wanted to counteract the spending coming from the government. And we don't want that, right? We don't want interest rates 12, 15%. We're all right if, we could still get 6, 7, 8, even if they go to 9. But once we start hitting double digits, that's going to cause a little bit of pain, too much pain in the economy. So you're right. I don't think much changes in that regard. I think it's all about right now, if we get supply side help, then things go well. The optimistic outcome happens. If we don't get supply side help, then the pessimistic outcome happens. And so just keep watching things like supply chain, keep watching oil prices, and that's really going to tell you where that overall inflation rate's going to head.
Thank you. Any other questions? Have time for one more question? Here we go.
Oh, and shelter inflation, right? Bringing this back to real estate, we need shelter inflation to go down. Sorry for multifamily owners, but we need shelter inflation to go down.
Hello, my name's Joe Sharps. I work for a developer in town, but my question revolves around that. Actually, you talked about the labor force and skilled labor versus, unskilled labor, what have you. But the unskilled labor, if you will, the restaurant workers and things like that are struggling specifically in our area to pay for the higher rental rates, and the rental rates keep going up for a renter like myself. Where does the normalizing point hit? What is the trigger, and when does the breaking point? When do these restaurants that cannot fill their workforce fail as a result of this?
Yeah, we've seen a lot of failures because of this earlier on in the pandemic. A lot of people think it was lack of demand through the pandemic, but no, it was actually a lack of workers that really hurt a lot of these restaurants. So there is very much something to what you're saying. When it comes to the housing side of things and just the general inflation side of things, yeah, this is a tale of two cities, folks. There is really, the U.S. has a good deal of inequality, and this is only making it quite a bit worse. From the real estate perspective, we haven't built Class C, Class B housing very much in this country. If you look at from a national perspective, the statistic that I give, it's basically in the last 2 decades, we've built 85% Class A, 15% B or C, and a tiny bit of affordable LIHTC type properties and things like that. So this is not going away. What I think it has to happen from the housing perspective are more public-private partnerships, because I'm sure many of you in this room are probably developers, and you're making that decision, right? Land is darn expensive, and so if the calculus makes sense to build Class A because you can get a lot more rent from that, right? Versus the extra cost of making it Class A, versus if you made it B or C, and what you take away from the cost of making it B, C, it almost always has been, penciling out that building Class A makes sense. That's why the last 20 years those numbers are that way. So that's not going to change, I don't think, anytime soon. So I do think public-private partnerships are what's going to have to help the lower income class with housing. And I think local governments are going to have to really think about how to handle that type of situation that you're dealing with regarding some of the service workers.
All right. Well, Tom, thank you so much. We're going to move on to our next speaker now. We've got some other questions that came in for Tom, which we will hold till the end. As I said, we'll have a Q&A for our panel and both speakers. But at this time, I'd like to introduce, and it's very appropriate with all the discussion on workforce and labor. That's one of the big drivers in our market. And as you look at markets around and some of the growth markets like a Salt Lake with all the colleges and universities, in a very close proximity to the city. What are we seeing here in Idaho? And so with that, I'd like to introduce Hope Morrow. Hope is a labor economist with Idaho National Laboratory. As most folks know, that's one of the larger employers in eastern Idaho and in the entire state. Hope has been with the Department of Labor previously in both Utah and Idaho, and has been appointed, I believe she's the policy chair, now appointed by the governor with Idaho's Workforce Development Council. So with that, I'd like to turn it over to Hope, and we'll all have an opportunity to hear about what's happening with jobs and workforce here.
Perfect. Thanks, Jim. Well, it's certainly a pleasure to be here with all of you today, and Tom, fantastic. Not usually do two economists get to speak back to back and not directly after a lunch hour. So I'm pleased that everyone's awake and great turnout today. So like Jim mentioned, I'm Hope Morrow. I'm the resident labor economist for Idaho National Laboratory, and I also run all of our workforce development strategies for INL. So today we're going to talk a little bit about INL because I have a captured audience and INL is really cool, but mostly about the future of the development of energy, where we're going as far as embedding nuclear and thinking about the world a little bit differently in 2022 and beyond, and then of course the labor market. So we'll just get right into it. So what you're looking at here is our timeline, INL's timeline as far as advanced nuclear reactor demonstrations. For those of you who are not particularly familiar with Idaho National Laboratory, we exist in eastern Idaho, but we have an 890 square mile desert site out in the middle of Idaho. So if you know your state relatively well, you know Boise, kind of the whole corridor, that dead space that you have no idea what's going on right in the middle, that's us, okay? So we also have a very large campus in Idaho Falls, small offices in Salt Lake and Boise. But what you're looking at here is first of a kind micro and small modular reactors that don't exist anywhere in the US. And we're doing a majority, if not very close to all of the types of research at a national laboratory to deploy and test on these reactors to bring clean energy, a more diversified portfolio, so that we all get to keep our lights on regularly. We get to do it in a clean way, hopefully save our environment a little bit, and keep Idaho at the forefront of some of these technologies. The earlier half of these reactor projects are demonstrations or tests. So we're going to utilize those to make our portfolio as clean as we possibly can and head carbon free by 2031. And then the latter half, and why this is so impactful to workforce, is we're looking at 3 reactors, the X-Energy, the Natrium, and the Voyager, that will all be deployed in western Wyoming, eastern Idaho, and central Washington, that will be commercial energy producers, okay? So what that means is we have a variety of workforce in all areas that touch the energy space, from janitors to technicians to engineers, et cetera. And where we used to kind of be the hub in nuclear in eastern Idaho, and we keep our little family of workforce here and we train them very well. Now people are going to start taking them in the Rocky Mountain West. So we have to really think about kind of expanding just our labor market, which we're already having a really hard time managing in the first place. But just a lot of new technology growth. nuclear energy is a really nice caveat or sample set for what we're seeing happen in the CHIPS Act and some of the advanced manufacturing space. We're going to see a lot of emphasis around tech deployment and research development here in Idaho and kind of beyond our walls just by a little bit. So as that pertains to where we kind of go in the future, right? I think it's not a new topic to talk about resiliency and net zero energy. INL wants to be at the forefront of that. Our entire premise is to make the energy future a clean and healthy one. So we're looking at melding these systems together, using some of those test reactors and that new deployment in the nuclear space to mix with our traditional energy resources that either live on our land or will potentially do that. Mix those into a system that is healthy and makes INL's campus net zero by 2031. But the basis for this is we want to be a shining example so that all of our developments, our cities, Boise at the large end, maybe some of our rural communities have clean, resilient energy right in their backyard. We have communities in rural Alaska that call us on a frequent basis. Can we get one of those reactors? Can you ship it up here through Canada, because we want to make sure we have clean energy for our communities year round. And while all of that sounds absolutely fantastic and fun, as a dismal scientist, it's my job to bring everybody down 1 or 2 notches at least in the presentation. So we need a workforce to be able to do all of that really fun and cool stuff and make our future brighter. So just a snippet into INL and INL's workforce needs, and then we'll kind of expand into Idaho. Just in the next 5 years, we're looking at just under 3,000 job openings, and quite frankly, I do these projections, but I think they're conservative. End of fiscal year 22, we anticipated 900 openings for full-time permanent INL employees. We actually hired and onboarded 850, and we have 500 postings currently up starting FY23. So we have a lot of growth happening. Obviously, we're a federal laboratory, so we get a lot of funding for our research, but we really bring a lot of economic growth, supply chain development, and all those kinds of things to our local economy as well. And this is just a drop in the bucket. So let's talk about the region. INL obviously is a portion of that. You can see our headcount growth down here on the bottom left. We're at about 5,500 employees right now. We'll probably be in the mid 6,000s by 2025, 2026. Well, we are not the only player, as we all know. Anybody heard the Micron name lately? Maybe just once or twice, a couple Facebook posts. We have a lot of regional growth happening. We have all the way throughout the pandemic. It's not a secret. If you live in the Treasure Valley, you see it. I lived in Eastern Idaho for 6+ years, and even in a smaller community. Every time I go back, which happens to be like every other week lately, there's a new building, a new business, more housing. The entire state is growing really rapidly, and that is mostly due to this type of expansion. Tom mentioned it, right? Businesses are going to where labor is. It's no longer just about where you want to live or where you want to be or affordability. It's about where the jobs and the opportunities are, and Idaho happens to be an opportunity mecca. So when we look at, can we pop that slide back up? When we look at these projects in particular, there's a lot of really great opportunity when we look at massive regional growth. So between Micron, the Meta expansions, all the Amazon buildings, and INL alone, I thought we should do a little experiment, because why not? So I thought, let's look at these 4 projects in particular. We touched 3 really major industries. Let's say, on a more conservative side, 7,000 new direct jobs. Micron just said 2,000, INL is around 1,500, got the Amazon warehouses, et cetera. If we do just a basic jobs multiplier, we're looking at an additional 4,400 indirect and 4,600 induced jobs. So to the gentleman that was asking about the service industry, this is what we're talking about. We're talking about our construction trades folks, we're talking about our servers, we're talking about our nurses. These additional 9,000 jobs we have to have also come into the community and grow to facilitate just the growth that we're seeing in these 4 projects, these 4 industry partners. So in a potential, when we're looking in a small lens at our big commitments, our big new growth opportunities, that's an additional 16,000 jobs in the state of Idaho that we weren't already on the trajectory of doing, potentially. So it's all really positive. We're really, really excited about all the things that are coming our way, right? we feel really good about it. But I'm going to bring up, Jim mentioned we've been talking about a labor shortage for years, all the way through the pandemic, and we're still going to talk about it. Our labor shortage impacts our ability to do a lot of things. Our ability to keep our restaurants' doors open all the hours of the day that we want to eat, our ability to put those folks in affordable rentals, have enough housing, single family or multi, that's available to bring people here. So we really have to think about what those opportunity spaces are to alleviate a little bit of that pressure, typically at the local government side of things, but really as a state, we're doing a lot of communication about that. The workforce development conversations are really surrounding that. So when we look at this graphic in particular, you can see the job openings line is the green one, and the blue line is Idaho's unemployed residents. For those of you who math is not their strong suit, we're looking at, that 40,000 gap, those amount of jobs, 40,000 potential jobs are open right now. We have 40,000 jobs that cannot be filled by unemployed residents. Our unemployment rate in Idaho is about 2.7%. Full employment, unemployment is at 5%. So we are below full employment, which feels really nice, but that also means no one can hire anybody, right? We're having a hard time. So then let's just tack 16,000 jobs on top of that, easy, and unemployment hasn't changed. So we are going to continue to see this pressure on the labor market, which will, push potentially us into this wage inflation cyclical conversation, hopefully not too far. But we will have to see a little bit of cooling in the market if we want this labor market to condense and relax even just a little bit. In the workforce space, we can talk about a labor shortage all we want. We whine, we look at graphs, we think about how hard it is, we try to excite people to come into Idaho or work for a certain employer. And we also talk a lot about education. We say, do we have enough people going into X degrees or seeking specific types of education that then could potentially fill those jobs? And really, we're doing a pretty good job. We have a lot of folks going into STEM. We have a lot of people staying in the higher ed system and graduating and staying in Idaho or coming into the state. But a lot of those folks aren't necessarily going into jobs that are related to their degree, or STEM degree people going into STEM related jobs. So when we've been doing a lot of focus into pushing people into becoming more skilled or having a higher level of education to take those jobs, now we're seeing that those people aren't even ending up in those industries potentially. So a lot of work to do in that middle ground between getting your skills and becoming employed. And then the last slide that I'll share here, I think that Idaho's labor force might be our safety net. And Tom talked a little bit about this as well. But when we think about going into a cool down potential recession, one that may be deep, probably not anything like 2008, but we could get there. Our labor market is so healthy, too healthy. We need some carbs, okay? We need to liven up a little bit, loosen up a little bit, see some cooling. You can see the comparison here, the unemployment rate in that purple bar down at 2.7%. What you're seeing across the screen is university and community college enrollment over the last handful of years, almost a decade, I believe. Normally, when we go into a recession and unemployment rates spike to 10%, people go back into education, get a new certificate or skill, and then they come back into the labor force more skilled and better off potentially than they were before. But if we don't see that happen, if our unemployment rate only comes up to 5% or 6%, and people don't go back into the education system, that will really transition how we as employers or developers or hiring managers think about what's on someone's resume, because experience will have a whole lot more weight than education ever has. So when we think about those policies, the impacts to our workforce and ability to recruit people in, these all play a role. So there are some benefits, of course, to a cooling market. We'd love to see a few of them, but I think that so far so good. We're hanging in there. Our labor market's tight. It will continue to be that way. If you have friends in other states, tell them Idaho's great. Don't talk about housing prices. I know there's a few of you in here who talk about housing prices every once in a while. But we're doing okay. We're feeling good. Boise's doing great. The state of Idaho's doing great. We're going to keep pushing on. But it's a pleasure to be here with all of you today. I think maybe I'll have one question if Jim's got one. So thank you.
Thank you, Hope. Again, time for one or two questions for Hope, if anybody's got one. And we can save them to the end. I see one way in the back here. I think Amy's got the microphone.
So how would you suggest that we artificially increase the number of people going back for higher education? How do we combat that low unemployment rate and still get the highly educated workers we need?
Quite frankly, I think that just comes down to people's choice, right? So if we make the choice better or easier to go back to school and get retrained, i.e. scholarships or incentives or additional opportunities for students to be more flexible with work, that's probably going to be the only way that we're going to see more folks enter the higher education system and continue to grow their portfolio, because right now you can walk down the street and 10 people or 10 businesses in the next 5 minutes would hire you. So you don't necessarily have to put in that work unless it's worth it to the person. So I think that we're seeing that across the nation. I know that Idaho is certainly talking about it in the government space, in the workforce space, that we have to make it worth it for the labor force to want to do those things. And now you're seeing employers increase wages, potentially, paying back student debt or having packages where they'll pay for schooling, those kinds of things. I think we're going to continue to see that, and maybe at a more rapid pace, because it's got to be about the choice.
Any other questions for Hope? One question I've got, Hope, that was asked is, you talk about this shortage, 40,000 jobs, 60 available, 20,000 people unemployed available to fill those, so we've got this shortage. We have to recruit elsewhere. Mm-hmm. We've long brought people into the state based on cheaper housing, low-cost housing, and it's a great opportunity. That's gone now.
Correct.
I mean, we all know that the market has really increased on a housing price. What are you seeing from a recruiting standpoint? You obviously recruit some very high-level people. What are maybe the major impediments that people look at, and the major advantages when you're recruiting and looking to bring people into Idaho to fill these jobs?
Yeah, absolutely. Great question. And Jim's correct. We all used to be able to say, it's cheap, we've got a lot of land, the mountains are cool, come here. And we still try to say that. Sometimes it pans out, sometimes it doesn't. We do still have the natural beauty that I think we all tack on to the package. But in general, it's much, much more difficult to recruit people to Idaho because the cost of living has gone up. The advantages, I think, to Idaho that still exist and will continue to exist is, and Tom mentioned this first, so thunder, we'll share the thunder, is, we're on the front facing of that tech engagement, of that deployment, that research and development piece, that advanced manufacturing space, energy space. These are kinds of areas that are going to drive our economy and our development. And if our workforce wants to be a part of that, if they want to see change in the world that they live in, which we all know culturally is more and more prevalent in the workforce interests, Idaho is a place to do that. Idaho is a place to be a part of that big change, the future of those opportunities. But of course, there are a lot of impediments to bringing people here. Politics play a role in whether or not people want to move to certain states, and wages most certainly do, affordability, all those things. So we try to lean on the side of, we have a lot of growth and economic opportunity regardless of the industry that you're going to be in or might want to be in. Education is accessible, and it has been for a long time. It will continue to be, and quite frankly, it's a great place to be. But that's kind of where we're leaning now. It's much thinner of a line than it used to be. So.
Absolutely. Well, Hope, we want to thank you. A lot of great information. Obviously, the workforce dynamics are critical. And with that, we're now going to call up our panel of local Colliers experts and have a bit of just an open roundtable discussion on some of the topics that they're seeing and what's happening here locally, deals that you all are involved in or hearing about. And I've always wanted to do this. I always wanted to be a baseball announcer, but I want to again thank our sponsors and presenting sponsors, Washington Trust, A10 Capital, Givens Pursley, and while our speakers are coming up to the stage, we're going to take a 30-second break for a word from our sponsors.
Hello, I'm David Bailey from Land Pro Data. I've been an engineer in the land development business for almost 30 years. I have spent plenty of time driving around to pick up a record of survey, waiting on hold to speak to a city planner, and searching multiple city websites for agendas and plans. Land development professionals need a more efficient and faster way to reliably get the critical information we need to identify, buy, develop, and sell land. I want to help land development professionals take this to this. That's why I started Land Pro Data, to alleviate the hassles our industry faces in retrieving land information and instead focusing on winning the work. Land Pro Data is here to help you do your job, save you time, and produce reliable information quickly.
Why Land Pro Data? Real estate professionals. Locate desired property. View plans for adjacent properties and ownership information. Comprehensive parcel reports, assessments, and building permit history in the click of a button.
Thank you, Land Pro Data. Now I want to introduce our panel. I know many of you logged in online, and you might have seen a different name and face as one of our speakers. Brian Vaughn, who's one of our retail specialists, unfortunately is ill and wasn't able to make it. And for those folks that have been in the industry, you probably know Mike Christensen. Mike jumped. It took him about a half a second to agree to hear himself speak. So Mike is here in Brian's stead to speak on the retail sector. Mike Pena. Mike has been with Colliers for a number of years and is in our Nampa office. We have the only dedicated office, in commercial real estate in Canyon County. Mike works with a great team over there and works in all sectors. And he'll talk a little bit about Canyon County and some different unique aspects of what's going on in the valley. And then next, Karina Gilbert. Karina is a longtime office expert here in the Treasure Valley. She joined Colliers in May of this year. And so Karina will be giving her insights on the office market. And many of you have come for years. I think Bill Johnson mentioned that. How did we actually get Clay Anderson off the stage this year? Clay, as you know, leads our multifamily effort and our multifamily team. And this year we've got Spencer Hansen, who joined Clay's team a little over a year ago and is just taken off doing transactions in the multifamily market, has a wealth of knowledge, and so he'll focus more on that today. And then finally, Steve Foster. Steve, another long-time member of Colliers here in Idaho, and Steve is an industrial expert, and he'll be giving his insights on the industrial market. So with that, I just want to, again, thank Tom and Hope and for the information they provided. And we have, as everybody registered, you had an opportunity to put in some questions. So I'm gonna throw some of these questions out to the panel. I want to start because one of the things that I found very interesting and also a little bit humorous is that every banker that's here submitted a question asking us what will the cap rates be in each sector. And I find it kind of funny because, well, first of all, a little lesson on cap rates for those that may not know what a cap rate is. Very simply, a cap rate, that's the percentage return on the capital you've invested in a property. The percentage that the income that you make off it represents. So very simply, you buy a property for $100, and at the end of the year, after all expenses, you bring in all your rents, you make $5. That's a 5% cap rate. You're getting 5% return on your capital. And very simplistic way to look at it, but because there's a lot of factors that go into it. But one of those factors for developers, for landlords, owners, is interest rates. And interest rates is part of your cost of capital. We heard Tom talk about rising interest rates, and so I just, maybe a little bit flippantly would like to ask all the bankers in the room, could you please give us your crystal ball, tell us what the interest rates will be every day for the next year, and we will tell you the cap rates. It's a simple formula, but no, it really is it's a very much dynamic that is important to watch. As interest rates rise, cap rates will follow. Cap rates should rise because if you're spending 6% on a cost of capital, but you're only getting 5.5% income from your property, you're upside down. And so Generally, you'll see most developers will want between a percentage point or 2 percentage points spread between, what it costs them to develop the property and what their return is. Obviously, different market cycles may raise or drop those parameters, but that's in general. So I'm going to throw it out just to our group. We hear so much about cap rates. Anybody who wants to jump in and to just talk about what you've seen in your sector overall in the market, where do you see things going?
Yeah, Jim, I would say that we've seen over the last few years compression in cap rates pre-pandemic through the pandemic to present, and even though we've seen the cost of capital get up to the 6 to 7% range, the majority of our transactions we're still closing below the cost of money. So cap rates on single tenant retail, we're seeing anywhere from 3.5 to 4.5 caps. Multi-tenant retail, we're seeing anywhere from 5.5 to 6.5. It's a question everyone asks, that are we going to see cap rates rise this next year as interest rates continue to increase? And it's interesting that we've seen so many buyers come into the market. It used to be years ago, it was all coastal 1031 money, but now we are seeing buyers and investors from all over the country, and they're closing well below the cost of money with 1031 or all cash, and not that a big portion of the buyer pool has diminished with increased rates. We're still closing transactions well below the cost of money.
Thank you, Mike. Anybody else have thoughts on Karina?
I would say the same for office. There's not a lot of inventory. The cap rates, Q2 we were seeing 5%, Q3 5.7 I believe it was. So there has been a little movement there, but it really depends on the product and the situation of the buyer. So, and without a lot of product out there, we're still seeing it move.
Spencer, from the multifamily perspective, that's obviously with all the development going on, and they've got to be paying close attention to the interest rates and cap rates and the spread. What are you seeing?
Yeah, it's not just the bankers that are asking that question. It's all investors are asking the question of, how do I value this property, and how do I take into account the impact that this interest rate movement has had on the valuation and the pricing. And for investors, it's with the way that interest rates have moved, investors, it's almost a daily refresh of your model to see, okay, what's my cost of capital today? How does it affect my returns, and how does that affect my pricing? So, we, fortunate or unfortunate, came into the spring with almost $250 million worth of listings and had a front seat to see exactly how investors were reacting the entire time. So, what we're seeing is property performance is continuing to improve. Interest rates are continuing to increase, and which forces, like you said, cap rates to go up. And so you have these kind of opposing forces where it's really hard to pin down where things need to be. Ultimately, what we've found is that there is investor appetite to flex below the cost of money as long as investors can get into a positive leverage position within 12 or 18 months.
And I think that's one of the critical components that Spencer's touching on is for developers. With interest rates, you heard Tom say he believes there'll be another 75 basis point increase in November, maybe another 25 or 50 in December. So if you're a developer sitting today and you're trying to figure out what your return is, but you're just getting ready to acquire the land, then you have to entitle it, and then you get your construction loan, it might be 6, 8, 12 months from now. That's the difficulty, is knowing where those rates will be when we're in a moving market. And that's where I think we hear a bit of the term, where folks have used the term pencils down. So right now some developers are just saying, hey, we're pausing, we want to wait and see. While interest rates will be increased through December, the stop and see mode from the Fed that Tom talked about is a good thing, because it provides some certainty, and then you can better build a pro forma and understand what your returns are going to be. So I think, you know, to a non-answer, and I'm looking at Andy Beatty here from Washington Trust, and he's trying to heckle me for picking on the bankers, but we don't know any better than anybody else watching the markets and trying to understand this inflationary versus recessionary, you know, environment that we're in right now. But safe to say that cap rates generally will rise above what the going cost of capital is, and so the interest rate trend is going to ultimately dictate where those things level out. You know, I heard for the first time today an expression about location, 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 but it's not what we've heard for years. The expression was location, location, location of the labor force, of the employees. And, you know, with all the negative news and things that are out there, we still maintain a really positive outlook on what's going on here in Idaho. I think if we look at Hope put up, you know, Amazon, Meta, Micron, these are some pretty major announcements. And it's interesting, Mike Pena with Colliers and on our panel is also very involved on the board of CWI. And so, Mike, I'd just like to throw out and a little different angle on you know, the Micron announcement. How did that come about? What role did education and CWI play?
Well, as you alluded to, I have a very fond spot with CWI. I've been on their foundation board for several years and took over as the president of the board just recently. And frankly, without CWI, I don't think this Micron manufacturing facility would have come to fruition. That the training of the labor is so critical, and I think Tom and Hope both alluded to that. We're looking at around $10 million we think is going to be inputted into CWI from various sources. Part of that's going to come from Micron. Part of that's going to come from state and federal funds through the CHIPS Act. We're looking at about 2,000 actual workers that'll be in the actual factory. There's going to be several thousand other support workers there, but those 2,000 folks that are working in the fabrication facility, about 1,000 of those are going to be touched by CWI. They're going to be the technicians, so they're going to be going through the CWI Megatronics program and our semiconductor transition program. CWI is so important to this community, not only for your traditional associate's degree, which, by the way, we're $139 an hour, per credit. You can do 24 credits for about $3,300, by far the lowest education provider in the state. But we also have a very big CTE training program, technical training education program, which, you know, your plumbers, your welders, and I hope everybody in here will continue to support CWI, because without this cheap, affordable, accessible workforce training, our jobs are going to be very difficult.
And to our fifth presenting sponsor, CWI, the
Yeah.
plug we just provided to them. So, Mike, we will send you an invoice for your sponsorship
No worries.
after the event, but we appreciate you coming and wearing you should have a CWI tag on. But
Tattoo right here.
well, and I want to piggyback on Mike's comments, because obviously we all saw the Micron announcement. That's a real positive and very much a long-term positive. But I also saw an interesting dynamic where everybody heard about 17,000 jobs, and then it's 2,000 directly at Micron. So where are these other 15,000 jobs coming from? And I'm not saying they're not coming; they are. I'm curious if any of our folks have seen, you know, other industries, other businesses looking at the area now as a result of this Micron announcement.
So on the office side, we definitely have. We've seen new companies looking to come to Idaho since the Micron announcement, and then some existing that were already looking either from out of state or inside that are now growing. We had one that was about an 8,000 square foot requirement that doubled in size on their requirement. So, and then along with that, we're seeing more tourism activity in the Boise and east side of Boise, southeast Boise. So we're definitely seeing an impact since that announcement came out.
Steve, on the industrial, you see an uptick in interest?
Yeah, I think the Meta announcement, the Facebook announcement, has created a square footage lease of two separate leases of 150,000 square feet over in southeast Boise to directly support that project that's going on. So that was a significant lease for a local developer that's got his building under construction. It's pre-leased. So big win for him.
And a big win for the area. Again, I think these announcements of these larger companies, Tom talked about you attract folks and then you attract businesses. Well, we're in that phase where the businesses are definitely being attracted, and that is great for the long-term runway for the Treasure Valley and for the state. I know someone asked me, he said, well, are we going to go into a recession now that Micron announced? And I said, well, it's not quite that fast. This is taking place over the next 8 years or so, and that's really important to keep that long-term perspective and how positive it looks here. Steve, staying with you for a minute on the industrial, we've all heard about the industrial market and the how much it's grown across the country. Can you give a little information? It sounds like there's an awful lot of industrial space getting built right now.
Yeah, there's a wave coming. We're tracking approximately 4.7 million square feet to hit the market here in the next year or so. We've got, from Caldwell to Boise, I've got probably 11 properties. We're tracking 11 properties under construction. These are huge 3, 4, 5, 6 building projects. To provide a little bit of examples on square footage, Caldwell's got 305,000 feet under construction. They call it North Ranch. That building's just about shell complete. Moving down to Nampa, we have 6 projects under construction, totaling 2.7 million square feet. And then in Boise, we count 4 projects totaling about 1.7 million square feet under construction, 4 projects in southeast Boise. One of those is pre-leased, as I mentioned, but that's 4.7 million square feet that's going to come hit the market, and we're excited about that. We've been working in a 2% vacancy market for years, and we need more product to do more leasing, and these companies that are looking from out of state to come to Boise, we've lost deals, we've lost opportunities because we didn't have product that they could lease. So Salt Lake City got the deal or Portland got the deal. We're going to change that.
So those are some big numbers, though. We've been at such a low vacancy rate, 2%. You instantly add 4.7 million square feet. Doesn't that drive our vacancy rate into the 10, 11%?
Yeah, that'll increase the vacancy rate, but at the same time, we got to do some pre-leasing. We've got to get some of these projects pre-leased so that when these buildings hit the market, I think it'll drive the vacancy rate down to a healthy 6%. And that's a good number because I think both landlords and tenants benefit. It's not like this, it's more like this, and everybody wins.
Well, and that's an interesting idea that the more vacancy, the easier it is to attract a tenant sometimes.
Absolutely.
Or a company because they don't want to wait 18 months or 2 years for a space to be built. Some of them are ready to move. And if you're someplace else and you're relocating, once you announce to your employees, if you're not ready to move, you're going to lose a lot of them in the relocation process. So having space, a 5, 6, 7% vacancy rate is healthy. Are you seeing, if we have that absorption of some of the new space and we drive down to the 6%, are you seeing the activity to support that?
Yeah, I think so. And also, not only us as sales and leasing agents running with deals, running with requirements, but in speaking to some of the municipalities here, the economic development directors are very, very bullish on what they're seeing from out-of-state companies that have big deals, triple-digit deals, 100,000 square foot deals that they're just waiting for the product to be available. So they're out there working their thing, and they're saying that, yeah, we will get a lot of this leased up.
That's terrific.
And that's a product type that we've had in the past. We've lost a lot of projects because we didn't have a 100,000 square foot vacant building ready to go. So having some of that inventory, I think, is a positive thing.
So, speaking on industrial, that's been obviously one of the hottest sectors for the last several years, and we hear about it all the time. We see it here with a lot of the new space, the evolution of retail into warehousing and distribution. One of the other areas is multifamily, and I'm curious, Spencer, an interesting tension right now as we see Meta and Amazon and Micron and all these new jobs they're talking about, and then Hope says we don't have the people to support them, so if we're going to have to recruit people from out of state, they've got to live someplace. And what are you seeing in the multifamily market right now, the development trends and opportunities?
Yeah, those announcements are really can't be overstated in the impact that it's going to have on the Treasure Valley over the next 5 or 10 years. And one of the common criticisms that we hear of the market is that our population growth is exceeding our job growth. And those Micron, Meta, INL are all great examples for us to point to and say, hey, there's really great high quality jobs that are coming to the market, and that's just going to continue to pile on demand in a housing market that's already incredibly tight. Our multifamily occupancy right now across the Treasure Valley is 95% plus. Single family home affordability is getting further and further, less and less affordable as time goes on. So one of the solutions is, hey, we need to add supply to the market. And the signals the past 2 years have been, okay, we've got significant double-digit rent growth, we've got a ton of population growth, we've got single-family home affordability skyrocketing. That signals to builders and developers to supply the market and to provide units, housing units to the market so that we do have safe and affordable housing. Interestingly, the effect of the interest rate have put a lot of those developments on pause, which creates a little bit of a gridlock and a little bit of a complicated waters that we're kind of wading into to figure out, okay, the people are coming, the jobs are coming, we need to house them. Right now, it's hard to make those developments pencil with how interest rates are. So how are we going to solve that solution? And luckily, there are smarter people than me working on that.
Well, and it is a tough question. It does point out one of the dilemmas that our market's in right now. We're going to continue to grow. Folks are going to come. We need to continue to have smart planning, mindful planning to take on that growth. I know there's some difficulty in, well, can we support a new multifamily development? Do we have the schools for it? Do we have the infrastructure for it? Well, it's not really the infrastructure for multifamily development. It's the infrastructure to support the growth that's happening. And I've often used the example of Austin, Texas years ago when they said, if we don't build it, they won't come. Well, they didn't build it and they kept coming. And it's now the 10th largest city in the nation and has really struggled for several years. They're working on it, they're improving it, but trying to catch up with all that infrastructure. So we need to be mindful of that and know that that's happening, whether it's single family or it's multifamily. The folks need to have a place to live. We can't attract the companies if we can't house their employees. They're going to look elsewhere. So I think that's certainly one of those things. When I asked Hope about one of the impediments right now to attracting businesses or attracting new workers, that's one. We have to solve the housing answer all the way up and down the scale. From affordable to the higher end homes. We need to have that development happening. There's a lot of talk, and we're talking about vacancy rates of 2% in industrial, and I think we hear that a lot. We hear that 2% number as a very low number, but interestingly, we're pretty low across the board. I think, Mike, Canyon County, what are we looking at right now as far as vacancy rates in the different sectors?
Well, since we've opened up our office in late 2007 or 2008, we've been keeping track, and the numbers that we're seeing now are at or near record lows. Industrial at 1.9% vacancy, retail 3.6%, which is very low. Here's what will blow people's mind. Office, 1.2% vacancy. That's the lowest since we've been tracking. I believe that's the all-time low for Canyon County. And then multifamily, we're just over 1%. So overall, all market segments in Canyon County are as strong as I've ever seen them. And then Steve talks about some of the industrial projects that are in construction. So those are going to bring additional job demands, not only on the industrial side, but support for office and retail. And so, we've got some great infrastructure there going into this recession. Having these low interest rates are great, but We've also, again, it comes back to housing and workforce training and who's going to fill these jobs on these new industrial buildings. So we've got some work to do on that.
Well, as I drove around with Tom LaSalvia yesterday a bit, we talked about the live, work, play concept and needing to be having things closer so you're not commuting across the valley. What are you all seeing as far as trends for growth and where it's happening, where the if there's 3 million square feet of new industrial space coming in Canyon County, I assume there needs to be new, more housing to support that. What are you seeing overall, Mike or Karina, Spencer, on the trends on where it's moving?
Well, it's moving west, and I think the next big catalyst is going to be the Highway 16 connector. I mean, I don't know how many people have driven recently just before the Idaho Center, but you can see that they're moving dirt, and that I think is supposed to be done in the next few years. That connector is, that new off-ramp is anytime you see an off-ramp. I think we're going to see similar growth like we're seeing on 10 Mile right now.
Karina, you seeing the same thing in office? We can all look at Eagle Road and the highway and 10 Mile. What's the relative, percentages or growth opportunities between downtown and as we move west?
So for right now, vacancy overall is at 4.6, and as Mike said, 1.2 in Canyon County. It's about 5 in Ada County. But we have seen a lot of companies starting to move west, a lot still staying in Boise in the downtown area, but there's truth to location following labor, going to labor. So as we see unemployment as low as it is and companies trying to hire and attract and retain talent, they're going to go to that labor. So we have seen more companies moving west.
Spencer, are you seeing the ability for multifamily? Is there anything holding back development, as we move west and the opportunities to build more multifamily? Any impediments today?
Yeah, it's interesting because Boise and the Treasure Valley does have kind of geographical restraints to development, so it is all pushing west where the large tracts of land are. One thing that I think is really interesting is listening to Tim Keene, the new Boise Director of Planning and Development Services. He said that cities, other American cities that we're looking at and kind of modeling our growth off of, one of the things that happens is the regional population growth increases significantly, and the city population growth stays flat, which just creates this kind of sprawling effect where you just gobble up every piece of land that you can. And one of the part of the fabric of the DNA of the Treasure Valley is that agricultural component and that open space and that open land, and that's important to I think preserve and maintain. So to me, it seems like the important thing is to provide housing where people work or where people play, and so as our regional population increases, so should our city population, and so should multifamily developments along commuting corridors that make it easy to get to employment hubs.
Well, certainly a multifamily development requires a lot less land than a large single-family development where everybody's on an eighth of an acre or a quarter of an acre, or larger.
Also on the sprawl to the west, I'm seeing more companies, and not a lot, but we're just starting to see this where companies are saying, hey, we really like being downtown. People live nearby, ride their bikes, have the amenities, but we're going to need a satellite office in Meridian or Nampa or Caldwell so that we can have offices in more locations, because commute time matters and the commute's getting a little longer for some.
Mike Christensen, on the retail side, we're talking about vacancy rates. What are you seeing right now?
Well, it's historically low levels, right? I mean, this could be a record we're at 3.75% in the valley. Virtually, there's no space left when you're touring various retailers through the community. The other problem that's popped up is Spencer. The multifamily groups have outpaid a lot of the retailers at some of these prominent intersections because they can pay more for density. So it's challenging in that sense. Retail's got some labor issues. Anyone that's been into any grocery store lately will see that half the check lanes are empty because of the lack of staff. And so there's some challenges there. Construction is tough, and so I think the retail vacancy stays low because the cost of construction and the labor side is going to keep a cap on the market. So I see a pretty stable market even if we do go into a recession.
Which is much different than where we were 15 years ago when you talk about vacancy rates and speculative building and houses that were empty, and then the banking crisis hits and it really threw this area into a tailspin. We're in a much better position.
No supply.
And
I think some of the single-family home builders are kind of using some of the scars from the last recession too. So I pulled some data before here and looking at building permits for single-family homes in Canyon County. And in September of 21, there was 318 single-family permits pulled. September of this year, 67. So I think we're seeing some pullback and some of this choppiness that's going to be happening with the interest rates going up and the affordability issue, and it's
well, and again,
not,
it's all
not coming on as strong as it was in 2008 when I think it was everyone had their blinders on. It was
right.
Just moving forward at full speed.
It's all how you look at numbers. I view that as a very positive
I do
statistic right there,
Yeah.
that where it's more controlled growth and more controlled building. When you say, I think you said 68 versus 318, some might look at that and say, whoa, the housing market's crashing. They're not building anything, but it's keeping
inventory
that supply
management
in check. Yeah. Shifting gears for a second, Karina, all throughout the pandemic and for the past few years, the continued question on office and are people getting back to the office? Are people using the office? And then, I listened to Tom and Hope both talk about how you attract people here. What are you seeing right now in the office market? Trends for landlords. What are they doing? To get tenants into their buildings.
So I will say Boise being kind of unique when you look at the national numbers and compare it to Boise, people were coming back to work a little sooner. Most of our office users are under 4,000 square feet, fewer employees. We don't rely on public transportation, and people started coming back to work. And then we saw the need for collaboration and wanting to work together. I think we're going to continue to see more of a hybrid approach to working back in the office, but people are in. We don't have the sublease space on the market the way we're seeing other markets have, and our vacancy rate being at 5% is still much lower nationally. It's about 16.6 and higher than that in places like Houston and San Francisco. So
Isn't San Francisco at a 25%?
About 20% is the last I saw.
20% vacancy rate. So
Yeah.
that's a real good relative comparison, 4% versus 20+%.
Yeah, and we still see companies coming here. Probably about a year or two ago, I started hearing some resistance. Companies prior to that were coming and bringing their team and looking at homes and going, it's affordable. And I know we've talked about this a bit already today, but that affordability, as it started to go away, the teams were coming and going, I think I'll stay where I'm at, not moving here. And so we saw a little pause on some companies making the move here. So I wonder if the housing costs starting to dip a little might actually help bring some of these companies to Boise again. It'll be interesting to see.
So with that, the companies that we're looking, are you seeing, versus the ones coming now? You mentioned that with Micron, you had some tours of people that are, in related. Are there industry changes that you're seeing in the office market here? Any trends that are, that are different today than they were a couple of years ago, as far as who's coming?
Definitely tech, which was spoken of earlier. I've seen a lot of growth in tech and engineering, and then also just alternative energy companies, solar companies that are growing batteries, and that affects software and tech and everything around it. So definitely seeing growth in those areas. And some of these companies whose projections were, as Hope had mentioned, conservative. They were thinking they'd need 20,000 square feet, and now they need 60. So it's kind of incredible some of the growth these companies are seeing. And again, we're going to have to look at the unemployment, and thanks to places like CWI and the other colleges educating people to fill those positions.
But you brought something up just earlier when we were talking, and I'm curious, you talk about all of the alternative energy and the climate change discussion. You were talking a little bit about outdoor users and some changing trends, or maybe forecasting of some changes down the road. Can you share that?
Yeah, I've talked to a couple venue users who have outdoor space and the smoke, and this isn't affecting us as much in Idaho yet, but we wonder if it's coming because we're seeing in Idaho, California, Florida, where outdoor spaces are having to cancel events and cancel whether it's concerts or plays, and so we're curious. We did have the question come in, I think a couple questions come in on climate change, so whether smoke, flood, those kind of events are going to impact our use of outdoor space.
Well, certainly we've all seen, I think, 30 plus days this year, 38 days above 100 degrees. A little harder to sit in an outdoor venue if it's that hot, or if it's harder to breathe with the smoke. So it will be an interesting trend to watch as we move forward on those users and development, whether that picks up or slows down.
Also, sorry, you asked what landlords are doing, and I didn't answer that yet. So landlords are, for one, the rental rate hasn't really moved a lot. So the asking rate, the gap between the asking rate and the actuals, it's pretty tight. So what landlords are doing, though, is creating space, sometimes speccing space before a tenant comes in. A lot of the tenants need to move quickly, so if you can spec that interior space, which a lot of times we don't want to see someone spend the money if we don't know what that use is going to be, but being able to either spec it or do some kind of pre-design to show tenants what the space can look like. So a little upfront work is helping to get the tenants in. And tenants right now are looking for mostly Class A space, and we're just going back to the unemployment and trying to attract those employees. The employees want a shorter commute, but they also want light and bright. They want amenities nearby. Rooftop interviews, I hear, help. So yeah, anything you can do to attract that talent, and I think that also includes bringing them into work so that they're seeing each other and collaborating and having a good time to keep them there.
And certainly, Tom, one of the slides he had bears that out with the Class A space versus Class B, C, and how the Class A space, the demand is increasing and the others are dramatically decreasing.
Yep.
If we want to get people back to work, we got to give them a reason to get into the office. We got to make it a place that they want to be. And so I think that's one of the things we'll see is some of the amenities. And I'm also curious whether it's office or Mike retail or Steve, industrial. Are we seeing changes in rent? Not necessarily dollar rent, but rental terms, lease terms. There was a lot of talk in the pandemic about maybe people want shorter, maybe people want longer term. What are you seeing as far as lease term changes or trends?
A lot of speculation in escalations, renewal rates. We're seeing some groups push for CPIs. Historically, our annual increases we've seen in this market have been a lot lower than what we've seen over the last 6 months. I've seen several deals in the last 60 days where they have 5% annual increases. And CPI is coming back into play more and more.
It used to be that landlords, for me, would want longer leases. 5-7 year leases are great. They were almost preferred. The recent trend I'm seeing now is a lot of landlords are kind of preferring that 3 to 5 year lease. And then instead of a known escalator for option years, they want to do it at market rent because they're predicting that those 3% annual bumps are going to keep up with inflation over the next few years. It's one trend I'm seeing.
Same thing in industrial, Steve?
Mm-hmm. Yeah.
Terms are all changing a bit. And I think that points to the uncertainty that we talked about in the market. Again, trying to predict where we're going to be a year from now or 2 years from now with changing interest rates, inflation, recession. Landlords they don't want to get too far behind the market rate if it increases dramatically, and typically you can't have too strong an increase, built into the lease. Karina, you were going to add something?
Yeah, I was going to say office might be a little different then, because I am seeing the shorter term on renewals or existing space, but as far as new space, I'm seeing longer terms. The construction cost and the the amount of money that needs to be put in for that tenant improvement allowance is requiring a longer term to make sense of it. So 5 to 7 years, occasionally 10 in office, but you don't see a lot of that, but 5 to 10, or 5 to 7.
More 7 to 10-year leases than 5-year leases based on construction costs.
First generation space, yeah.
Yeah.
Yeah, the barrier to entry on office is significant. And we're looking at County, our average lease rates are around $20 a foot. To build a new Class A, you're gonna need to be in the mid-20s, and so there's been this apprehension on moving forward with new Class A out in County because of that price difference, and I think that's one of the reasons that's been driving our vacancy so low. So I think over time, rental rates on office are gonna go up to stabilize some of that vacancy.
Well, and I'm having conversations with business owners that are, do we pay for the rent or do we pay for attrition if we don't have the space that attracts the employees? So, they're doing that calculation to figure out where to put their dollars. And I think examples like 11th and Idaho and Eagle View and Meridian and Blackstone are examples of spaces that have been Class A built during or, as we wrap up the last couple years, and they're filling up.
And I want to jump quickly, Mike, I've got a question for you, but Karina, one last question that came in from somebody texted it in, and I actually learned to refresh my screen, so I see there's actual questions on here. Are we still seeing a big spread between occupancy and utilization? Space may be leased, but people are staying home. Have we seen that delta shrink?
I think so. I mean, we can see it in parking lots filling up, that people are coming back to work. So yeah, I think there are occupants in those spaces. Yeah.
Yeah, we don't have we see that more through our property management side and have an idea of, when folks are back, and it's definitely been increasing. I don't know that we have a hard percentage, and that was one of the questions on what is the utilization rate, the percentage. I don't know that we have the answer, but it's definitely increasing and improving. And people are getting back into the office.
I recently heard a term, managed occupancy, which is basically companies looking at how they're going to manage the folks coming back into work, and basically saying, if you want to work in the office 2 or 3 days a week, that's fine, but it needs to be with your team on the same days, so that you're coming in with the purpose of collaboration, and then your head down work you can do at the home or other location.
Right. Mike, we talk about the Micron announcement and Meta and some of the others. Very recently, just within the last 5 or 6 days, the announcement of Albertsons, longtime benchmark here in the Treasure Valley, and the merger/acquisition with Fred Meyer, or Kroger, the parent company. What can you tell us about that? What's that look like for the grocery industry here in the Treasure Valley as that takes place?
Big news, in my opinion. If you look out in the valley at this market or other markets where Albertsons and Kroger have a big presence, you'll see that there's a lot of overlapping areas. And so I would assume if the merger's successful, you probably will see some closures in this market and other markets. I think that creates opportunity long term, but I do see a lot of overlapping areas in Boise and other markets. So we'll see. Kroger has a pretty good plan. They came out yesterday and said that they've already planned to spin off, I think it was like 372 stores, and so they're working strategically to be able to satisfy the regulators to seek approval for the merger. So we'll see.
Well, and that's a big issue. Obviously, they've got to get governmental approval to have that go through, and some of that will be determined by which stores stay open, which ones are rebranded. But I guess, picking up on a comment you made earlier, for the savvy multifamily investor out there, I might be looking at any intersections where you have a Albertsons and a Fred Meyer right near each other, because Albertsons is famous for having use restrictions. There won't be another, if they close that store down, there won't be another grocer or a pharmacy. But boy, Spencer, you can get some multifamily buying prime real estate pretty quickly.
There you go.
Great infill sites.
Great infill sites, great redevelopment sites. Well, with that, I want to thank our panel and thank you for all your input and insights today. We're going to open it up right now. I've got a couple questions if this thing doesn't die on me. And I'm going to welcome Tom and Hope back up to the platform here so that if you've got questions for anybody on the panel or either of our speakers, please feel free to raise your hand and we will come around. And I also may have some on the screen here that I can share directly. Mike Christensen, is retail dead? Is brick and mortar gone? We've
No.
heard this for 20 plus years, but what's the view with all the online?
You know, from my perspective, retail continues to evolve. I think it changes. As you see in the valley, any landlord or tenant is looking at it, some type of drive-through concept to still connect with their customer. And so, short answer, no, but it's always evolving.
Development impediments to development, interest rates or construction costs? Which is a bigger impediment?
Both.
Yes.
I think the simple answer on that question is a developer has an expense pro forma. All the expenses that go in, then they know what rents or return, whatever it is, income they need to get out, and that's going to dictate their cap rate and you know what they can spend. All of these things are impactful. As interest rates go up, your finance costs are heavier, and obviously any loosening or lightening in any of those areas is helpful. But right now we are seeing construction rates are very high and interest rates are very high, so that's going to continue to squeeze that. Tom, a specific question for you. And I know when I used to run a REIT and look at development and acquisition opportunities, Boise was a tertiary market. And we always talked about the primary or what we called NFL markets, and then the secondary markets, and then Boise was tertiary. And a lot of the REITs wouldn't even look at Boise because it just didn't, the demographics, the population numbers didn't support or provide a safe enough investment. So it was a questionable market. How does Moody's, how do you rate markets, and where is Boise, or where is Boise headed that you can see?
Yeah, it's a great question, and we have a primary set of metros, about 80 of them, and so really it's primary, secondary, I think, the way most people would think about it. And then we have tertiary, and Boise has been tertiary, and it probably shouldn't, and the reason that it probably shouldn't be anymore is because some of our biggest clients are asking it not to be, because when it graduates from that tertiary to the primary, there's more narratives, there's deeper data dives we do, and we're getting so many asks about Boise from national big time money clients that it's worth graduating. So we're actually going through that process now.
That's really exciting news for the area, and I'm going to pick on an old friend, Jason Clear, who's here, new to the area, but we worked together for a long time. He was an investment underwriter with the Phillips Edison Company, and I know he'll tell you that just 10 years ago, we wouldn't look at Boise for certain investments because of you look at lease terms, you look at the financial strength of the tenant or tenants, and then you look at the market. And for Boise to graduate or elevate or promote into one of the top 80 markets for Moody's, and again, I use primary and secondary, that's a combination. But again, that's another really strong long-term indicator for this market. That just shows that the growth is continuing, the strength of the market is continuing. We just don't see that slowing down. And if, I know I won't be able to pry it out of Tom, but when he says our clients, these are the JP Morgans or the big investment groups saying, hey, we like Boise, can you prop them up into that next, can you graduate them? That only means there's more interest in the market and more investment interest. So, that'll you ask about cap rates, Andy, that'll drive cap rates down if he would just put us into the higher ranking. But other questions, if you want to raise your hand, we've got a couple microphones, we've got a couple minutes if you've got any other questions. Yes?
Hi, good afternoon. Pete Resendez from Montoya Group in Caldwell, Canyon County. My question is to the panel about the micro businesses. We heard a lot about big business coming to the valley and a lot of investment in warehousing and space. But there's a lot of small businesses that are struggling because there's not retail space or commerce space available in the central thoroughfares of each city. So what's the investment like out there? What are you guys seeing for that? And I'm gonna give you kind of a clean example. Is the guy that owns a restaurant and is looking to expand to Canyon County, but there just isn't the retail space for that. And what is, it's already taken. So maybe if you guys can share a little bit or line up something in the near future or maybe in the talks or not at all.
What I would say is that we're starting to see creative concepts come to Boise, which I think eventually will work their way out to Canyon County. Couple different groups are opening these ghost kitchen concepts in these 5,000 to 8,000 square foot buildings, and then they're doing leases on 150 to 400 square feet of kitchen space that then allows that business operator to target that market in a given area. There's one that's planned over on Main Street and 17th that will have 8 different operators and made for small business to incubate them, grow them into larger businesses, or if they want to stay there, they can expand into the next space. But there are concepts that are coming out that are listening to that type of request or demand. So I think you'll see that here in the next few years head that way, because they're very successful across the country from a restaurant perspective.
All right, with that, I'm going to thank our panel, thank our speakers, and start to bring this to a conclusion. We're a lot of great information, and as I always know every year, I'm the last thing standing between you and free drinks, so I'll try and be very quick here. Once again, want to thank all of our sponsors, and one that I haven't mentioned previously, but Business Interiors of Idaho, now known as Freeform. If you hadn't heard, they had a merger with the acquisition of the group out of Spokane, and they've renamed to Freeform. They provided all the furniture up here today. They're one of the local experts in interior office furnishings, so we really appreciate Jeff Heath and his team and providing us the furniture for today. I think what we heard today, and I think people ask, well, what is Colliers' outlook? Where do you see things? The simple answer is we've got some tough times ahead. I think there's enough economic uncertainty that we're not just roaring at the pace we were, but we look at the pandemic and those 2 years, 20 and 21, as a bit more of an aberration. They weren't normal. We're returning more to normal. Because your house, I saw a stat that said houses are now staying on the market for 38 days. That's a 100% increase over a year ago. Boise's crashing. Well, most houses stay on the market for 4 to 6 to 8 months. That's more than norm. So we're not in deep trouble. But there are, and we threw this around a little bit in the office. There's some turbulent waters, right? And I'm happy to be in the boat that is where we are in Idaho to navigate through those waters. And being a little bit of a history buff, I'll make the analogy. I'm glad that we're on the SS Idaho. If anybody wants to look that up, and December 23, 1941, the SS Idaho was attacked off of the coast, off of Cambria, California. And unlike many of the other boats in Pearl Harbor 2 weeks prior, the SS Idaho escaped and made it through those waters. And I think we're going to do the same. And we're all going to work hard together and weather the storm. And I don't think the storm's going to be as severe as a lot of people have feared. So thank you to everybody for coming. One last thank you, and I need to do this. I was told of a statistic, and what I want to do right now is ask Amy McKinnon and Jen and Haley and Amanda, the marketing team, to come up here, please. I know they're probably hiding in the back someplace or getting something done. But our first Colliers Outlook in Idaho was held in 2004, 19 years ago, and we had 35 attendees. At the time, Colliers had about 18 folks working there, so 18 of those 35 were spouses and significant others. So we attracted a grand total of about 17 people to our first Outlook. And this year we had over 600, between 600 and 700 registrants. We now have expanded. We've got hundreds of folks across the country that log in and watch this virtually. Amy works tirelessly, her team, so a big thank you to Amy and the entire marketing department for putting this on. We will be back next year for our 20th annual Outlook, and I'm sure we'll have some exciting new twists and bells and whistles. We're trying to get a local banker. Maybe Andy's going to hang glide in to kick off the event next year. So with that, thank you very much. Please join us for some drinks. Please take a moment to say hello to all the vendors, all the sponsors. The speakers are available. If you have further questions, you can corner them in the main hall here, and we thank you for attending our Outlook.